Central bank digital currency, or CBDC, is simply a digital currency issued by the central bank and is recognized as legal tender by the government. Cryptocurrencies have been the first digital currencies we have seen. However, the first form of a CBDC has come through the People's Bank of China's current trial of the digital yuan. Since the CBDC is issued and backed by the central bank, it benefits from the trustworthiness of cash while also ensuring that the central bank remains a regulator of the financial system, an important aspect to minimizing the risk of price instability which is seen with cryptocurrencies. Due to its digital form, the currency has the convenience of online banking while also being cheaper to produce and store than traditional banknotes and coins. It also allows CBDC to incorporate and benefit from blockchain technology, a particular advantage of cryptocurrencies which reduces the risk of fraud. However, the incorporation of CBDC is important as there may be some key drawbacks if not addressed. If customers have the choice and choose to replace their savings deposits at commercial banks with CBDCs, due to its safety of the central bank backing and convenience of internet banking, then it could heavily decrease central banks' balance sheets, posing a large threat to the stability of the financial system. The Bank of England has already suggested limiting the amount of CBDC that can be held by customers in order to prevent this possible
If a digital
inefficiency.
currency were to be introduced, it should be taken care of by the central bank. The central bank would be able to effectively control the monetary policy to influence interest and inflation rates, especially in anticipation of private cryptocurrencies becoming much more prevalent in the community. A centralized digital currency can influence interest rates, forcing commercial banks to have more competitive rates. There is a lot of speculation about the risk on central banks. One of the bigger risks is the failure of the RBNZ due to commercial banks' inability to meet an increased demand in payments. It can be observed over the last 7 years in Ecuador that their digital currency has failed due to a lack of adoption of the currency by the public. This is a risk that can waste a large amount of government resources. Further risks include cyber threats as the system will have to be fully centralized, transferring technology risks
It
to
is
the public sector.
understandable that some banks are concerned about the impact digital currencies could have on the banking landscape. Between April 2015 and 16, over 600 branches in the UK were closed, and in 2016, HSBC reported that they'd seen over a 40% reduction in the number of people visiting their branches. If digital currencies continue to rise in popularity, physical banks fear they will become obsolete. If CBDC replaces traditional banknotes, a digital currency could allow easier access for customers to transfer their savings at the bank to CBDC. Hence, increase the risk of insolvency during economic crisis. As seen during the JFC, economic crisis leads to a high number of deposit withdrawals from customers who wish to hold their savings in cash as opposed to a commercial bank. However, keeping up with the technology and implementing into the traditional banking system will keep banks alive and support a safe environment for digital currencies to operate in. As seen in the Bahamas, where its own CBDC has put limits on the amount that customers and businesses can hold in their CBDC accounts, so that huge volumes of money don't get swept out of commercial banks.
Currency lending business depends on the fluctuations in the value of the entire digital currency market. Whether it is for lenders or borrowers, the greater the volatility, the higher the risk. The increased currency substitution caused by foreign central bank digital currencies may bring more financing pressures and sovereign risks. To avoid these risks, in a small country like New Zealand, the New Zealand government can introduce a variety of major central bank digital currencies to coexist. Competition can promote the discipline of currency management to maintain currency attractiveness. In conclusion, digital currency is a trend of currency development. Although it has some potential risks, the advantage outweigh the disadvantage. Our group's recommendation is not to put eggs in the same basket, which means advocating multiple stable international digital currencies to diversify risks.